Let me tell you about the most common way crypto investors lose money. It's not a bad exchange. It's not a hack. It's not even a bear market. It's a decision made at the worst possible moment, driven by fear or greed, that wipes out months of gains in a single trade. You've seen it. Maybe you've lived it. Bitcoin drops 20% in a week. Panic sets in. You sell. 2 weeks later, Bitcoin is back where it started. And you're sitting on the sidelines having locked in a loss that didn't need to happen. Or the opposite. Bitcoin is up 60%. Euphoria takes over. You put in more than you should. Then it corrects 30% and suddenly you're overexposed, stressed, and making decisions you wouldn't make with a clear head. The problem is not your analysis. The problem is not your timing. The problem is that you are human. And humans are not wired for this kind of volatility. Our brains treat a 20% price drop as a threat, the same way they'd treat a predator. The stress response is real. The urge to act is overwhelming, and acting on that urge in a volatile market is almost always the wrong move. So what's the solution? You build a system that removes the decision entirely. You commit to buying a fixed amount at fixed intervals, regardless of price, regardless of news, regardless of how you feel that day. That system has a name. It's called dollar cost averaging. And in the next 20 minutes, I'm going to show you exactly how it works, why it works, and how to set it up today. I'm Dax. This is Dax Crypto Lab, where analysis becomes action.
Get daily crypto insights by subscribing now.
Before we get into the mechanics of DCA, I want to make sure you understand why it exists. Because DCA is not just an investment strategy, it's a psychological defense system. Let me paint a picture. Imagine two investors. Both start with the same amount of money. Both invest in Bitcoin. The first investor, let's call him reactive, watches the price every day. When Bitcoin drops, he feels anxious. When it drops more, he sells to stop the pain. When Bitcoin recovers and goes higher, he feels left behind. He buys back in, usually near the top. When it drops again, the cycle repeats. He is always one step behind the market, always buying high and selling low, the exact opposite of what he intends to do. The second investor, let's call her systematic, never watches the daily price. Every first of the month, she buys the same fixed amount of Bitcoin. She doesn't care if it's up or down. She doesn't read the headlines. She doesn't check Twitter for price predictions. She just executes her plan. After 3 years, who do you think has better results? In almost every historical scenario, the systematic investor wins. Not because she's smarter, not because she has better information, but because she removed the single most destructive force in investing, her own emotional reactions. The fear and greed index exists for a reason. When it hits extreme fear, below 15, retail investors are selling en masse. When it hits extreme greed, above 80, retail investors are buying en masse. And smart money is doing the opposite. DCA is the mechanism that keeps you on the right side of that equation automatically, without requiring you to be smarter than the market. So let's get precise. What exactly is dollar cost averaging? Dollar cost averaging is an investment strategy where you invest a fixed amount of money into an asset at regular intervals, regardless of its price. The formula is simple. You decide how much and how often. That's it. Every week or every month, that same amount goes into Bitcoin. When the price is high, your fixed amount buys fewer coins. When the price is low, your fixed amount buys more coins. Over time, your average purchase price reflects a blend of market conditions, not a single unlucky entry at the top, not a single panic sell at the bottom, a smooth, disciplined accumulation across an entire market cycle. Let me give you a concrete example. Say you invest $100 every month into Bitcoin. Month 1, Bitcoin is at $50,000. Your $100 buys 0.002 BTC. Month 2, Bitcoin drops to $40,000. Your $100 buys 0.0025 BTC. Month 3, Bitcoin drops further to $30,000. Your $100 buys 0.033 BTC. Month 4, Bitcoin recovers to 45,000. Your $100 buys 0.0022 BTC. After 4 months, you've invested $400, but your average purchase price is not 50,000. It's closer to 40,000 because you bought more coins when the price was lower. That's the magic of DCA. The volatility that terrifies most investors actually works in your favor. Every dip becomes an automatic opportunity. You don't need to time the bottom. The system times it for you, gradually, mechanically, without emotion.
Get daily crypto insights by subscribing now.
Now let's talk about what this looks like in the real world, with real historical numbers. According to historical data, a $100 monthly DCA into Bitcoin starting in January 2019 and running through early 2024, a total investment of $6,000 would have grown to approximately $19,000. That's a return of over 200% on a completely passive, zero-analysis strategy. No charts, no indicators, no news, just $100 every month, without fail. Now compare that to the reactive investor who tried to time the market over the same period. Research consistently shows that market timers, even professionals, underperform simple DCA strategies over 5-year horizons. Why? Because missing just the 10 best days in Bitcoin's price history reduces your returns by over 50%. And those 10 best days almost always come immediately after the 10 worst days. The panic sellers miss them every time. There's another dimension to this that most people overlook. DCA forces you to invest during bear markets. And bear markets, as uncomfortable as they feel, are the best time to accumulate Bitcoin. When the price is down 50% from the all-time high, your fixed monthly amount is buying twice as much Bitcoin as it did at the peak. The math rewards patience. Every month you stay consistent during a bear market, you're lowering your average cost basis. And when the bull market comes, and historically it always has, that lower average cost basis translates directly into higher returns. Now the practical question, how much should you invest, and how often? Let's start with frequency. The two most common DCA intervals are weekly and monthly. Weekly DCA captures more price points throughout the month, which means slightly better averaging in volatile markets. Monthly DCA is simpler. One decision per month, usually aligned with your salary cycle. Historical backtesting shows the difference in returns between weekly and monthly DCA is surprisingly small, less than 6% annualized over 5 years. The more important variable is not how often you buy, it's whether you keep buying consistently. A monthly DCA that you actually execute every month beats a weekly DCA that you abandon after 3 bad weeks. So pick the interval that matches your cash flow and your discipline. Now, how much? This is personal, but here's the framework I use. First, it must be money you don't need for at least 3 years. DCA is a long-term strategy. If there's any chance you'll need that money in 6 months, don't put it in crypto. Second, it must be an amount you can sustain through a bear market without panic. If a 50% drawdown would make you want to stop your DCA, your amount is too high. Start smaller. The goal is not to get rich in 1 year. The goal is to build a position systematically across a full market cycle. Even $25 a week, $100 a month, compounds meaningfully over 3 to 5 years. Consistency beats size. Every time.
Get daily crypto insights by subscribing now.
Here's where DCA goes from good to powerful. The standard DCA strategy buys the same amount every interval, but there's an enhancement that professional long-term investors use, and it's completely systematic, completely unemotional. It's called fear-weighted DCA. Here's how it works. You set your baseline DCA amount, say $100 per month, and you add one simple rule. When the fear and greed index drops below 20, you double your contribution that month. When it drops below 10, extreme fear, you triple it. Why does this work? Because extreme fear readings, below 15, have historically preceded every major Bitcoin recovery. Not once in Bitcoin's history has an extreme fear reading failed to be followed by significant upside within 12 to 24 months. You're not predicting the bottom, you're simply buying more when prices are statistically cheap relative to market sentiment. The key word is systematic. You don't decide in the moment whether the fear is real or temporary. You don't read the news and make a judgment call. You set the rule in advance. Fear and greed below 20 means I buy double, and you execute it automatically. The data from the 2022 bear market shows that fear-weighted DCA investors who doubled their contributions when the index hit extreme fear outperformed standard DCA by over 40% by the 2024 peak. Same strategy. Same asset, just one additional rule applied systematically. Now let's talk about the mistakes, because DCA sounds simple, but most people sabotage it in one of three ways. Mistake number 1, stopping during a bear market. This is the most common and most costly mistake. You've been DCAing for 8 months. Bitcoin is down 40%. The news is terrible. Everyone is saying crypto is dead. And you pause your DCA, just for a few months, until things look better. Those are exactly the months when you should be buying the most. The months when your fixed amount buys the most Bitcoin. The months that determine your average cost basis for the entire cycle. Stopping your DCA during a bear market is like turning off your sprinkler system the day before it rains. Mistake number 2, switching assets mid-strategy. You start DCAing into Bitcoin. Bitcoin is flat for 3 months. You see Ethereum up 20%. You switch, then you see a new altcoin up 50%. You switch again. Every switch resets your average cost basis. Every switch introduces a new variable, and you end up with a fragmented portfolio and no meaningful position in anything. Pick your asset, commit to it for a full cycle. Mistake number 3, setting an amount that's too high. If your DCA amount creates stress, if you check the price obsessively because the amount matters too much, reduce it. The perfect DCA amount is the one you can sustain without emotional attachment. Boring is good. Mechanical is good. The moment your DCA starts feeling exciting, something is wrong.
Get daily crypto insights by subscribing now.
Here is your DCA setup, starting today. 5 steps. Step 1, decide your amount. Take your monthly disposable income, money you don't need for living expenses or emergencies. Allocate 10 to 20% of that amount to DCA. That's your baseline number. Step 2, decide your interval. Weekly if you want better averaging and your cash flow supports it. Monthly if you want simplicity. Either works. Consistency is what matters. Step 3, set it up automatically. Go to your exchange, Binance, BingX, or whatever platform you use. Find the recurring buy or auto-invest feature. Set it to execute automatically on the same day every week or every month. Remove the manual decision entirely. Step 4, add the fear rule. Open TradingView. Search for Crypto Fear and Greed Index. Bookmark it. Check it once a week, not once a day. When it drops below 20, double your contribution that month. When it drops below 10, triple it. Write this rule down. Stick it somewhere visible. Step 5, set a review date, not a check-in date. Pick one date per quarter to review your portfolio. Not to react, not to change your strategy, just to confirm your DCA is still running and your allocation still makes sense. That's it. 5 steps, 1 setup, and then you let time do the work. You run your own lab. Next Saturday, we go deeper into portfolio construction. How to decide what percentage of your portfolio should be Bitcoin versus altcoins versus stablecoins, and how to rebalance systematically without emotional decisions. If this gave you a framework you can actually use, subscribe. Every Saturday we build the system. Every Monday, Wednesday, and Friday, real-time market analysis. I'm Dax. This is Dax Crypto Lab, where analysis becomes action.